After borrowing 1.3 trillion US dollars from central banks, European lenders may still need extra cash infusions. Well, our next guest is a sovereign debt specialist. Let's get his insight on where we are in this crisis. Peter Schaffrik is head of European rate strategy at RBC Capital Markets, and he's in Tokyo at the moment. Peter, thanks very much indeed for joining us. So are these banks still in an equally parlous position?
Well, look, at the moment what we have in Europe, I think, is at least a dual problem, if not more, maybe even a triple problem. We have on the one side the banks who don't need cash at the moment, but we have in the bank side, we're looking for equity, and that's certainly a problem. But much more the problem is on the sovereign side, and how the sovereigns, particularly the weaker sovereigns in the south of Europe, how they're going to fund. And that's, of course, one of the biggest problems that we're seeing. And I don't think that the ECB, in our case, can do very much about the latter.
Well, we saw that Spanish bond auction last week, which, after a previous poor one, went off very well, and a lot of eyebrows were raised. What was your view on that?
It was true indeed. That auction was relatively well. That was relatively well covered. The size was okay, but we have to keep in mind that particularly that auction was relatively small in size. And if we go forward, there's still a lot of funding to be done. And if we look at who has been buying, we know that mostly the domestic banks have been buying, using in part ECB's LTRO money. And of course that is not forthcoming anymore. And the question mark is how much capacity do they have? And if they are not there, who's going to pick up the tab?
Well, indeed, well, the answer I'd give you is another round of LTRO then from the ECB.
Well, but the problem is, of course, that, as I was saying earlier, the banks have, in part, a capital problem that hasn't been dealt with yet. And the last thing you probably want is another round of increase in the balance sheet, where the opposite would probably be needed, deleveraging. So LTRO by itself is probably not going to fix the problem. I think we are rather looking towards different solutions for the sovereigns, which might be that we get the new powers of the EFSF in part being tested. But that is indeed the big problem. I don't think the ECB can be the all-one solution.
So what is being priced into this market and what's not been priced in your view?
Well, at the moment, what is priced in, I would say, is a lot of weakness to come in the peripherals. And that is probably what we're going to see in the near term. What we eventually will have to see is a significant turnaround in terms of how Europe deals with this problem and whether Europe opens its own balance sheet a bit more. But in the meantime, I think we get a little bit more of the same, which is strong bunds and relatively weak everything else.
Okay, well, of course, political concerns are also at the fore once again, the Dutch government falling, and we've also got the May the 6th runoff between Nicolas Sarkozy and François Hollande for the presidency of France. What is your view on that, as particularly the Dutch issue?
Well, the Dutch issue is a little worrying, I have to say. Not necessarily that I think the Dutch politics, at the end of the day, will do what is right for the Dutch. But what we do see in the market is that this has caused a lot of uncertainty, has caused a lot of volatility. And what we have to keep in mind is that the Dutch market was one of the last sort of surrogate for the bunds. And with that probably falling a little by the wayside, where investors become a little cold feet, that gives another push into the bunds and might make bunds even more expensive going forward. As far as the French are concerned, I think we have to really see what the ultimate outcome of a potential Hollande victory would be. And we think that there is probably a lot of negativity priced in that might correct in the near term.
Well, I'm also going to go back to Greece. The Bank of Greece saying that the economy there is going to contract by a more than expected 5% this year. That means that debt's become even harder to fund.
Indeed. I mean, funding the debt per se might not be the near-term problem because, of course, they have been covered by the program. But it, of course, means that potentially the Europeans are putting a lot of pressure on whoever's going to form the new government to impose some new measures, and that might indeed prove quite testing. Because what could happen is that, yes, we have the elections and we might form a government, and once it comes around to doing some of the measures that the Europeans might ask them to do, that new government will be in a very strong, in a very difficult position straight away. And that might, again, inject uncertainty into the market.
Okay, we've got the Federal Reserve, its meeting, of course, on Friday. We've got GDP numbers out too, plus on top of that we've got an FOMC statement coming through as well. What are they going to say and what is the market looking out for?
Well, the market is clearly looking out for any indication that there might be another round of QE in the making. Whether or not it might be forthcoming is a different debate. We certainly think it's not a done deal, that's for sure, although we think that the economy is going to stay relatively weak. And that is the thing the market is going to focus on. If we don't get any indications whatsoever, I think that might reflect badly on the market for the time being.
Thank you so much for joining us, Peter Schaffrik there from RBC.